Hello everybody, it's me the Boss Hog back with another portfolio update. A pretty good week honestly, although it could have finished a little bit better. We're also going to be having a look at Vodafone's new strategy from their new CEO and why I still think honestly it's a bit of a value trap. Let's do it. Alright, so in terms of weekly closing figures for my portfolio, nothing added this week. I did get paid today, or Friday, but I decided not to put anything in. Honestly, everything had run up quite a lot, and I'm sort of hoping with the debt ceiling and maybe some wobbles in various industries that there'll be better chances to buy next week, so I decided to hold that back for a little bit. Similarly as well, no dividends this week. That is expected. I did get a decent sized dividend on the Friday, but I'm not really expecting it to clear in my brokerage until Monday, so that's fine. And then the only other real update is on my realised profit here. I actually realised I forgot to record it from a previous sale. It's one of the few manual bits I have remaining in my sheet, and it basically just moves where the figure sits between realised and unrealised. So that was for my disposal of Fever Tree. Just the difference there is that. So I did a check on all my other accounts as well, just to bring that up to date. So on the good side, basically, we've seen a near £4,000 increase in our trading 212, and a similar figure, although slightly less overall, on our profit and loss, which is based on Google. But broadly speaking, pretty happy with the general direction of travel. So yeah, at the moment, that's our portfolio value, and that is our P&L. So still pretty modest in the scheme of things. And again, I hope to come back to the kind of all-time highs that we were in early February, just up here. But honestly, a lot better week, and I'm feeling a lot better for it. So in terms of catching up with our indexes, again, here we are closing down on the S&P again. I did spend most of the week actually ahead of it. Finally, some favourable FX movement, as well as some love in both the financials and the tech slices, where I'm quite heavy. You can see here that there was an audit done on my Google Docs and Trading 212, so just to make sure those things match. But yeah, so nothing else added. Our portfolio is not quite at all-time high, but it is pretty close. And again, here, the profit over time. I mean, this does look pretty good. We're definitely getting back up to where we were just a few months ago. But at the same time, this is probably the 6th rally that we've had, since a certain war happened over here. So I'm definitely not getting too excited or too ahead of myself. And I expect this sort of to continue, actually, for at least the medium term. And then we'll go from there. But like I say, catching up on the indexes always makes me feel good. And being green also makes me feel pretty good, but I don't want to be too green because I'm still trying to acquire shares, etc. You can see here actually a lot of my bigger positions actually have pretty decent weeks. I just wanted to talk about a few of these things because last week we were doing sort of earnings dives into 3 different holdings, and I thought it would just be good to just walk through these just a little bit before we get on to Vodafone. So in terms of Genius, I thought their update was stellar. I think a fair value here would be somewhere around $6, which I've nudged up from $5.50. They increased their margin expectations and EBITDA expectations for the current year, and broadly speaking, are just kind of firing. Everything's coming together, and they're hitting the milestones that they set out in originally it was January 2022, and they've been consistently hitting things since then. So that's awesome. And I mean, year-on-year change is really significant. I'm still pretty red on this, to be clear, about minus 34%, something like that, in terms of unrealized, and about minus 25% if I include some previous profit I made from them. But again, this is a long-term hold for me, so hopefully this will continue to run up and do me really good. My big tech ETF here, my Alliance Technology Trust, had a really good week as well. It's actually now closed in on its net asset value quite a lot. It was trading at quite a hefty discount. I wish I'd got a bit more and not been quite so stubborn about only buying underneath 220. But my average here is like 214. I did average up a little bit, but caught it really nicely. So I'm extremely green on this at the moment. But I don't want to sell anymore, so I'm going to keep this. I did sort of trim last week to open up my new Dutch ETF. But decided that I'm not going to do any more selling of ATT. I like a big tech ETF, and that's basically doing the job. It was a pretty good week for semiconductors more generally. Like Amcor here, my second largest, was only up 4.5%, so it's not green just because it needs to be above 5%, but still had a pretty decent week. Micron, though, also benefited not just from general sentiment, I think, from positive updates from some other companies within the semiconductor space, but also news that it was looking to get 1.5 billion from Japan, who are basically looking to improve their semiconductor manufacturing. So a bit of a kind of, I think it's called friendshoring, where you're not necessarily, onshoring or bringing stuff back to your own country, but you're sort of looking to spread your risk and sort of potentially the world's going to turn sort of bipolar again. But that's the kind of direction of travel, basically. So Japan obviously reasonably aligned to the West. Yeah, and that was positive news for obvious reasons, I think. By the way, if I just skip down to ASML here, very similar news as well. So although it didn't have the same kind of, again, 1.5 billion from Japan, which is seen as generally good sentiment. I did also see a few positive analyst upgrades. I would say at the moment, specifically with Micron, if you look at some of the forward PEs, it looks really expensive. And I mean, to be honest with you, I am a little bit tempted to actually sell at least a little bit of Micron, just because I think it's kind of up to date and slightly ahead, probably by at least 6 months of where really the earnings should be. But the expectation is that the cycle is going to begin again in sort of H2 this year, and so everyone's getting slightly ahead of themselves. Like I'm definitely, like, if this ran up too much more, I think I'd be looking to at least take some profits off the table, because then I think it would just be so far ahead of itself. I could probably make better use of it elsewhere. It's similar to what I did last week with Fever Tree. I decided to sell at 14.42. Just because I think it's broadly speaking up to date, and actually way ahead of itself, really. It's at least 18 months ahead with all the execution risks. So I think if it sort of crossed over into that barrier, then I would actually look to sell Micron. But for now, I'm just sitting on a pretty green position now after the last sort of month run up that it's been having. So that feels good. Speaking of now as well, very comfortably green on Google. I think it was really related to a conference that the CEO spoke at, where he was sort of mentioning the AI improvements, and it was just broadly well received. I also think as well, the fact that Google's performing as well as it is, despite the fact that we're broadly speaking in an advertising downturn, is really encouraging. So again, even though I sort of have Google a couple of times in various ETFs, I'm not going to sell this. It's quite a large position. It's sort of 2.5%. So for a single position, reasonably high. So although I sold Microsoft and Apple because I felt like they were broadly up to date and I have them in my Allianz Technology Trust, I'm not going to be doing that with Google. I've decided I'm going to hold it. Like, I'd need at least a 150 here. I think it's got plenty of room to run, honestly. So not tempted to sell this, even though I'm sort of about 6-7% green now on my share price. So yeah, we'll be keeping hold of that. Less good here is Prospect. I did an earnings review last week, so I don't want to spend too much time on it. But yeah, just more worries basically about both Prospect and Steward. So we'll see how that fleshes out. I would say that this company is so beaten up that unless those worries are significantly worse, they're about to hit the wall, not overly worried, but we'll see anyway. So I'm sitting on a pretty chunky unrealized loss at the moment, about 50% down, so very ugly. But I'm not selling at this moment in time. Speaking of a pretty red position, down about 20% on Disney. I actually didn't think the results were that bad. I mean, a lot of their misses were in the sort of lower margin Indian market in particular. And also, I mean, this week as well, they announced that they weren't going to be relocating their creative staff from California to Florida, I think for known reasons. Yeah, I mean, I'm still sitting on Disney because it's a case of like, don't doubt the mouse. But I mean, we're looking at like an EPS in the 80-cent range. So, even being generous, when you're looking at sort of a $4 EPS on a $90 share price, like, okay, it's like 22 forward PE. Kind of looks a bit expensive in the current market, And again, like, Disney here has huge potential to sort of cross-sell, use that branding. I think it has one of the most powerful brands in the world, as well as everything else behind, likes of ESPN. It's a huge business, really. But yeah, it's just not really pulling it together. I think they've kind of lost their way a little bit with their creativity, and obviously they've entered into the divisive world of politics. So I'm sort of a little bit. I'm watching this quite carefully. I think, like, if we're still looking at this in another sort of 6 to 12 months and it's disappointing, I may well look to sort of realize a loss. Maybe maybe an activist will come along and create a sort of short-term surge. Now, ideally, I think the company has the capability to turn it around, but it's just sort of struggling at the moment, shall we say. So, yeah, I'm keeping a very close eye on Disney. Again, I'm a bit torn because I think it has so much potential, but, if a business can't realize that potential, then it's just a bad investment, basically. So, I know some people are sitting on much more red positions. Other people have already taken a haircut. I guess I'd be curious for people's opinion on this one. I'm a bit torn, to be honest. Next up, this one's looking really ugly. So this is Polymetal. This is one of my two Russian miners. These miners were meant to be my hedges to a high-inflation environment, and obviously that completely backfired because they got absolutely mauled last year. It now looks like Polymetal specifically is going to be delisting from London and having a main listing in Kazakhstan. They already have dual listing, so that, again, this is a Russian-focused gold and silver miner, and they believe that they'll basically be able to realise shareholder value better and not be restricted in the same way that they are currently in London. It'll be interesting to see whether Everaz goes down this route, because it's even more restricted because their largest shareholder is heavily sanctioned by just about everybody. Depending on who you believe, potentially Everaz is supplying steel for tanks, although Everaz themselves deny that. So arguably you could even say that Everaz is in a more sensitive position than Polymetal, but I'm sort of expecting to be forced to sell this in the next couple of months, and if I am, it would be a pretty bad loss, about £5,000. So probably I think that would be my worst loss to date. Not much I can do about it, really. Like I say, it was a mistake. I think I'm trying to sort of look on the optimistic side here, and I think the mistake was that I didn't give enough weight to non-business reasons. I probably should have, because, I sort of bought and sold Alibaba for the same reason. I was sort of uncomfortable with the geopolitics. And I guess here I just didn't give enough weighting to it. I mean, both of the businesses were absolutely fine at the time and arguably slightly undervalued. But again, I just didn't expect things to go this way, and I probably should have done a better job protecting my capital. I would say one of the lessons I did learn is when the whole banking crisis started to happen and all the regional banks took huge dives, I did jump out of H-band, so Huntington Bank shares, quicker than I did with Everaz and Polymetal. I could have been a bit quicker, to be honest, but again, I managed to sort of protect a lot of my previous gains from Huntington. So I think I did get a little bit smarter there in terms of capital protection, but definitely something to reflect on. Next up, DLR. No real news here other than, I think, disappointing earnings. It's had a difficult year, really. Again, I'm a little bit tempted to just sell this and put this somewhere else. This feels a bit now like not too important. And it's actually in the same ISA that I have my ETF for REITs in. So it'd be very easy for me to sell this and basically move it across into the ETF. So I think I will think about selling this as well. I want to have a bit of a think, but it may well get trimmed in the near future as I look to tighten things up. I guess that's everything. Although, like I say, I did do a little bit of a mention into the this new Netherlands ETF that I got last week. It's a very shallow ETF. It just has 25 companies, but they're all on the bigger side. And again, I really wanted exposure to the Netherlands. I'm also currently considering getting a Japan ETF. It's one of the other areas that I think maybe there's some run rate there. It's kind of been flat for the last few years. And I am considering Japan, even though I do now have sort of, emerging markets and Asia one as well. But yeah, may well go for the for a Japan-focused ETF. And of course, it's not in emerging markets. That's sort of, your Southeast Asia rather than Japan. So broadly speaking, I'm happy this week with the direction. Quite a few greens, but yeah, one or two of the reds are particularly nasty, and Polymetal is looking really grim, unfortunately, but not much more I can do on that point of view. Because technology's had such a good week, it's now a very large part of my portfolio, so depending on whether you split out the ETFs or not. Again, I think I have here a position where I don't really want to go above 50% for technology. I think that's, although I am technology focused, and I think it makes a ton of sense with my risk profile and time horizon, I don't want to go anything further than 50%. So we'll keep a slight eye on that. But again, I do expect to be adding to various things that will reduce the percentage of tech in due course. No need, I don't think, to talk about dividends because there was none received this week, and I'm sure everyone's very curious about Vodafone, so let's do that now. Alright, so before we start, a couple of disclosures for anybody who's new to my channel and doesn't know about me. I work in telecoms. I've worked with Vodafone in the past, but never directly for them. And I thought about doing this video a couple of months ago when the previous CEO basically got fired, but decided not to just because I had what I would consider to be inside information, specifically on the likelihood of certain candidates being hired for the new CEO role. That knowledge I had was effectively that Vodafone weren't paying enough or willing to pay enough, and weren't willing to take the kind of remedial action and turnaround that other CEOs and chairmen of the kind of caliber really wanted. And to be honest with you, I'm quite disappointed with the fact that they went with an internal candidate. I'm not massively surprised. Again, I think it was almost inevitable. And I think you have to take these results and a lot of what was said alongside them with an element of skepticism about, the new CEO who is actually, been the CFO for the last 5 years and has been at Vodafone for a couple of decades now, can't really be seen as like a new person in the room, because she's been in the room for at least 5 years, right, in the CFO position. So first of all, just to talk about that just a little bit and put that out there, I don't have any existing information, and that's kind of why I feel more comfortable talking about this now. I'm also going to say that their new strategy, if you can call it that, to me, is a bit vague. Like customer simplicity growth. Like really only one of these three is valid, in my opinion, as a strategy. Growth and customers is kind of a no-brainer. It's like, and actually, if you do the business right, you sort of get those things anyway, right? And depending on exactly what you mean by growth, is that revenue or earnings or scale and network, right? There are different ways you can measure it, I appreciate, but okay, fine. And then customers is even more vague to me, because again, if you're doing everything right, in theory, your customers should be growing and should be happy. There is some focus here on sort of back-end customer satisfaction metrics and things like that, which we'll get to shortly. But honestly, I find it very vague. I will say, though, the simplicity one is absolutely the biggest problem that Vodafone has. We'll touch on this as we go through the deck, but, my working experience with Vodafone is extremely poor. I've hired people who've literally worked for Vodafone in their interoperability billing department, which is basically when Vodafone pass data records to each other for basically no real gain, and effectively have like these shared services and these weird management structures and everything else that just don't really make a ton of sense. And on top of that, they've got sort of legacy propositions. Some stuff's managed from groups, some stuff's managed locally, but all of the strategy is basically all over the place, dated, and doesn't really scale very well as a result. And like the business itself is kind of like a collection of telecoms assets without any sort of unifying vision, consistent approach, and I guess strategy, really. It's, to me, I've been in telco my entire working career, so we're now looking at the better part of 15 years, and I've only ever known Vodafone to be a loser. Every time I deal with Vodafone, I'm really disappointed with their technical and commercial expertise and flexibility. And yeah, during that time, basically their share price just continues to fall. So their share price is down about 57% in 5 years, and it is currently trading at levels last seen in 1997. So this is a business that for a quarter of a century has basically gone nowhere, despite buying things really poorly, in my opinion, again, as we'll get to in a second, and making a ton of mistakes, where it feels like now everyone else has caught up, basically, and there's very little that really differentiates Vodafone, perhaps with the exception of a pretty good brand and a reasonably sizable network. That said, what I will eventually get to is that you could definitely argue that this looks cheap. It's trading at a 60% discount to its book value, and it's almost a case of how much lower can it go. We're looking at a near 10% dividend, and if the new CEO is able to turn this around in any kind of way, there could be definite room for improvement here. So, you could think of what was recently done at Aviva by Amanda Blank. I think that's kind of a good example of what could be done. But then you also look at examples like TalkTalk, for example, where, again, you had a female CFO and still have one, actually, but previously it was Dido Harding, and I would say that turnaround ultimately failed. And again, similar problems with complexity and difficult business to manage, shall we say. Anyway, all that said, let's have a look through this deck. It's 30 slides. We're going to look at most of them, but not all of them, so let's do that now. So, Again, this is from the CEO, new CEO now, and she's still technically the CEO as well, a CFO. My understanding is that Vodafone have gone back out to market to try and find an external CFO. But again, I'm deeply skeptical about this because either the CFO matters in Vodafone's hierarchy, in which case, you know, what was happening with the new CEO for the last 5 years, or it doesn't matter, in which case, why is it so important to get an external CFO? You know, it's just a bit frustrating from that perspective. We'll see who I end up with, but I don't have any inside knowledge as to how that's going or anything along those lines. So, more or less, new CEO comes out and says, Vodafone must change, we're underperforming. And that's definitely the case. So, first of all, I thought this first slide was really interesting. This is actually one of the reasons why I personally don't invest in legacy telcos. This week, also, British Telecom got kind of mauled with a kind of panicky response and a big firing, restructuring of half of their workforce that was poorly managed, in my opinion, and not very well explained. But this is the problem with legacy telcos. They're having to constantly invest a lot of their sales into CapEx, and they just don't have a particularly good return on investment. In fairness, though, very few are as bad as Vodafone, as we'll get to in a second, where whole countries are actually negative on return on investment, and it's just really disappointing, basically. So yeah, I thought this graph was actually super interesting for anyone actually investing in the markets. And yeah, I personally don't touch legacy telcos. If I was to pick one, it would be Telus, and I just think that's because actually it's got a lot of its back end in good order, and it's also got the Teledoc service as well to make it slightly more exciting. So yeah, that's where that is. If we then move on to the next slide, this is Vodafone specific, and this is just really bad. So yeah, Germany, Spain, Italy, and UK, and it's just really ugly, as you can see here. Only the UK is seeing revenue growth, and actually most of that is caused by inflation-led price increases rather than anything else. Germany is terrible, Italy is terrible, and Spain looks like an absolute disaster. Look, I mean, minus 10% revenue is just really bad. I also thought the other graph was kind of interesting in terms of customer satisfaction. The problem with this graph is I have no metrics on the y-axis to really know what this means. Okay, apparently the UK here is a bit of an outlier, but so what? Like, the UK is also failing as well from a revenue perspective. And again, just to be clear, it's really difficult for me to understand how a telco which has been able to increase prices because of CPI is doing this badly, right? Revenue should be increasing even if earnings are under pressure, and it's just gone very wrong, basically, for reasons that we'll get to in each one of these markets toward the end of this deck. So Vodafone must change. This is how they structure their business. It's worth pointing out that really here, a lot of the business is within Europe, so you can kind of divide much of this across Europe, and you can think of this as like a 3/4 European business and a 1/4 Africa business, I would say. And you can see within the markets here, I mean, Germany is just about, around WACC, so rate of return. And Germany is the largest market. It's about a third of Europe. And then, you've basically got the rest are sort of between 10 and 15%, give or take. So yeah, the UK, Italy, Spain, and Romania. Romania doesn't matter too much for the purposes of Vodafone, but every other business unit there, Italy, Spain, and the UK, is material. It's like 10%. So the fact that they have a negative return in those countries is really bad, and yeah, shouldn't be seen as positive here, despite the fact that there's some green on this. Like, actually, if you look at the size and what matters, like Turkey's like 3% of Europe. It doesn't matter. So it's really the other stuff which is important, and unfortunately, it's all their bigger stuff. So I had a look at this. Like, yeah, we do have a couple of strengths. Mobile network, sure. Their African operations are going quite well, although actually still missed targets on a couple of their measures. I would say that's quite disappointing. And you do have some other good companies if you're interested in Africa, like Airtel would probably be my pick there. I think it's a perfectly reasonable investment, and it does have strong brand recognition. I think that's definitely true. However, I don't really see the engaged and experienced team. Certainly from a customer perspective, maybe they've got really good like internal engagement surveys or something. I'm not sure. And here, the leading B2B is a bit dubious because it's very specific, and again, we'll get to it in a second, but basically it's something called Soho, which is a single owner, or single office, sorry, or home office. So this is like, you know, your one-man bands that are kind of using their their Vodafone broadband to do business. It's not really kind of, you know, enterprise level. And again, my dealing with Vodafone was on the indirect sales channel, so add them as a wholesale partner. And they're so bad. They're like the weakest in the UK by a long way. And just their lack of technical expertise is just, it's so far behind Orange in particular, and E actually as well, and to some degree T-Mobile. But it's just like the weakest company I've worked with. Regularly you would raise questions whilst in operations, or questions while scoping a solution, and it was just impossible to get answers to. Everyone delegates everything, no one takes any ownership, and it turns out that they can't do stuff. Also as well, one of the things I do know about Vodafone is every time they try to like launch new products, they basically have to go through a central system, so central billing system, central ordering system, and in order to get any changes into those systems, it takes months and quite often years for anything material. So, you know, you've basically got like these product owners and these country owners trying to sort of make changes in some cases, and then they just get caught up in sort of Vodafone bureaucracy. At least with the likes of BT, for better or worse, they have like lots and lots of billing systems. So at least, you know, if you're one of the kind of more nimble companies that they own, you know, you'll kind of have some flexibility, even if you will eventually still run into the slowness of the incumbent. Vodafone don't even have that. So, yeah, and I think really that's an extension of structural complexity. Reduced commercial agility, again, I see that absolutely is true. Insufficient customer focus, again, I agree, and suboptimal local scale. That's kind of interesting what they talk about with local scale, which is that at the moment they believe that everything is being run through HQ in West London. Yeah, maybe, but it's also very inconsistent in that approach. So some stuff is and some stuff isn't. And again, like countries are expected to do all of much of their own stuff in certain cases, and then yeah, go through HQ and basically get slowed down by group in other cases. So I definitely recognize these limitations. I recognize some of these strengths, but again, I think it's flattering. Basically, I think they've got a lot more limitations than they do strengths at the moment, frankly. In terms of the transformation, then again, a lot of this is kind of sensible on paper. There's nothing wrong with it, but it's like somebody from marketing wrote it. It's really like frustrating. And to be honest with you, because I deal with like quite competent people, if I did this slide, like it would actually get torn apart for having a lack of rigor. And I know that this is basically just a pitch. I know that she's still getting her feet under the table, but again, I'm skeptical on that point. But again, it's so generic and obvious. It's like consumer dominated organization. Sure, okay. And like balanced, focused on business and consumer. Okay, maximize business potential. All right, how are you going to do that, right? Like this is an okay aim, but sure. And it's like, and then they're so dominated by it, but apparently it's inconsistent and not very good and everything else. And it's like, okay, we're going to get back to basics. All right, that kind of makes sense. I can see that, right? Let's get rid of the complexity, rid of the simplicity. Again, I think the simplicity is the right focus from a strategic point. And then it's like customer driven growth. Well, what does that mean? Like, it's that, so you want to get new customers. Well, okay, but then what's the earning look like for those customers? What's your focus going to be? Like when we get to Germany in a second, you're about to see that they're in a real situation regarding the ARPU and what the products that they're able to sell to customers and the way that they have to put it into a contract and etc. So again, it's like there's some questions there. I do think this, to be fair, this second point down makes tons of sense. You basically want more customers. All right, fine. And you're going to do that by simplifying the product catalog and, you know, just giving customers what they want. All right, okay, fine. Complex structure. I completely agree with this. This is, yes. But where I'm really skeptical is delivery. This is like one of those big organizations that, again, I've been dealing with Vodafone for over a decade, and everyone knows like it's not a very lean and it's a very complex organization, and yet no one's doing anything about it or has been able to do anything about it. So pretty dubious there. And this last one here, so suboptimal capital allocation. Again, this is definitely true. One of the reasons why I'm so bearish on Vodafone is because their acquisitions have been really poor. Basically, Vodafone bought a ton of assets, both, well, across the world and in the UK and in Germany in particular as well, where they basically bought sunsetting technologies. So they bought like cable, legacy broadband, international usage networks, and all of those things are basically being replaced by fiber, by IP calls, right, by SIP. I mean, other companies refer to this as the race to zero, right? There's literally no money to be made anymore in most usage. And in the future, there won't be any to be made at all. It's all about revenue, recurring revenue, and basically moving customers from legacy telco to IP to hosting to the higher value stuff. I just don't see it from Vodafone at all. The way they deal with both their direct channel and their indirect channel is lacking commercial acumen and smart, really. So it's like they've got themselves like 35 billion pounds of debt on 3 and a bit billion free cash flow, and it's just like, even though they're selling some assets and they brought down debt materially, to be fair, this year, it's still a pretty indebted business, and their assets just aren't going to scale very well into the future at all. So it's like, yeah, suboptimal capital allocation here. Like, this point needs to be so much broader, and it's like portfolio right sized for growth. Like, what does that mean? Like, that just means something is about to get disposed of. That's probably what it means. And to be honest, what it means really is Italy and or Spain is about to get disposed of, because they've already got rid of the towers and a couple of the smaller countries that weren't performing, like Ghana and like Hungary. So what it really means now is that they need to get rid of the Spain and Italy to kind of free up more capital. Probably get 15 to 20 billion for those businesses together. So that would definitely produce something that you could work with, and hopefully then they'll have like a final chance to really scale into the future. But to be clear, they bought badly, they're badly organized, super inconsistent, super complex. And so even though I think like these things have been identified, they were known to everybody for years. So I'm just really frustrated and again, this shouldn't be seen as new. Like, this is like what's been going on for this many years. Really frustrating. To be fair, there are fewer things that sort of unify focus within a management team and within a wider business than an existential problem. And I want to be clear. I think, like, not today, not by the end of this decade, but by 2050, unless Vodafone changes, they won't be a business. Like, it'll be owned by somebody else. Like, it's that bad. And I think like when people look into Vodafone and they see a cheap business, yeah, it's cheap for a reason, and like, it always looks cheap because it's a rubbish business and it just hasn't built very well. And it's like 9% yield kind of looks good until you consider that it's going down sort of 10% every year. So at best, it's going sideways. But yeah, so I think here this transformation again, I'm just very skeptical about it. The point about simplicity is a fine point. But again, how do you actually deliver that? And everything else here should be known and isn't really expansive enough to deliver what it needs to. More of the same, really. Sure, you want to become best-in-class telco in Europe and Africa. Fine. Good luck. And Europe's leading platform for business, again, like, it's going to be a very specific type of business. And by the way, there's absolutely money to be made in Soho and small businesses and everything else. But again, that's typically where your resellers come in, right? This shouldn't be where an MNO is pitching itself, right? Do you seriously want to be dealing with like millions of single households? Nah, you don't. Like, this is like, even BT, right? Like, they have like Openreach. And then they have like BT Retail, BT Wholesale, BT Enterprise, etc. And then you'll have partners as well. Like, they have local businesses that go out and sell their products. And it's like, you get this hierarchy that happens in telco because, again, major mobile network operators don't want to be dealing with Joe Blogs and Co. or whatever the German or Spanish equivalent is that, right? So it's just like, yeah, I'm not seeing, like, again, they just won't be successful from a wholesale perspective. Like, I've worked in the industry long enough to know that Vodafone's offering just isn't particularly attractive. It's just that, really. So even though they are seeing some success with Soho, very dubious about the rest of this. Again, structure redesign here makes sense. I've worked with telcos that had very similar. Actually, when I was last working in Labara, it's fairly similar, right? Again, it's actually quite similar markets that the companies operate in as well. And so, yeah, so you have a bunch of centralized expertise for things like legal, HR. There's definitely enough overlap to justify central. But again, actually, there's quite big differences as well with legal. Like one of the things that I was heavily involved at was looking at payment regulation in Germany. And I had to go and get a local third-party German lawyer to give me advice on certain regulation because actually the UK lawyers didn't have that information, right? So it's like, it's all very well talking about this, but you also have to remember that European markets are different, and this isn't just like a a Brexit thing where the UK is diverging. There's big differences between European markets as well, because the way EU directives work is that the EU comes out with a proposal, and then individual markets will interpret it, and inevitably different markets, different countries interpret them differently. So you end up actually with quite a lot of divergence. There's a big difference between Spain and Germany, for example, and indeed Italy, France, Netherlands, etc. So it's like this is a fine aspiration, but you need to make sure it's followed through. And again, you need to have the sophistication. Like there's nothing wrong with having a centralized billing system, right? That's a system I know best of all. What you need to make sure is that, again, the products are configured correctly for different markets, that different rules are considered, different invoice structures are enabled, different products are enabled, right? Different payment processing is enabled, etc. That all needs to be thought of, and it needs to be a very slick process. It's actually quite difficult to unify everything because there's inevitable complexities, and especially with a legacy business, there'll be platforms and people from yesteryear that have never been integrated and basically are just like an additional complexity. And I'm very skeptical at the moment that Vodafone really has got the full understanding to deliver this plan. So yes, this makes sense. But we'll see. Like local market simplification, like what does that actually look like? How much actually comes in? What's left, right? That also matters. Like because when we get to countries, they talk about countries having the ability to do the commercial selling, etc. But we need to make sure that that is viable, that it works, that they're sort of acting proportionately. Again, Vodafone in the past, BT in the past had big problems with its Italy division, right? It turned out it was basically committing fraud. So you need to make sure that you're managing your geographic footprint correctly and not having sort of bad behavior embed itself. This is kind of fine as well in terms of the action plan. Leverage new in-market autonomy for local agility. Again, tons of buzzwords here. Depending on exactly what you leave in market, yes, this can make sense. Product managers, etc., are normally really good and should be listened to because they typically know their stuff. But again, how is that then going to be developed, delivered, financed, etc., measured as well? Kind of matters quite heavily. Enhanced B2B sales management. Again, Soho's fine. I have huge skepticism about the commercial and technical aspects for anything beyond that. Investment in customer care. So you'll see very shortly that of the 11,000 people that are going to be fired by Vodafone, right, which is about 10% of their workforce, there's no contribution here or improvement to profit. All of that money is being reinvested into customer care effectively. So 250 million a year, which in a way is a good thing because, we can agree that there are improvements that they can make there. But again, I don't think it's enough. And I also don't think that Vodafone have really convinced me with their track history of development spending. So it's like, okay, I really need to be convinced here. It does make sense. Like a lot of people now just expect usage and their telephone to just work, right? Like it's no longer that exciting that you can send a text message or a data connection and it just works. Actually, a lot of telcos are running into this problem where people just expect this stuff kind of free. And it's similar to sort of media organizations, for example, right? Why buy a newspaper when I can just go online and get it for free? It's like, why do I need to pay for a call when I can go on Skype and do it for free? It's like you have to be giving an additional service. So the back end systems start to matter more and more. So it's like it's no longer enough to just have a big network. You need to make sure you're getting value off that network and that customers are willing to accept that they're being provided with value so that they'll happily pay you. And yeah, it's all very well having a big network, and to a point you can manage that, but I just think the direction of travel in telco is more about the value add, more about the smarts. It's incredibly competitive, and you need to really be mindful about how you're delivering the network and basically earning as a result. So again, reinvigorate Vodafone brand. It doesn't need a reinvigoration. It's fine. Maybe it needs a rehabilitation in the wholesale and business sphere. But broadly, everyone knows Vodafone, right? It's a really recognizable logo. Oh, simplicity. This annoyed me quite a lot. Commercialized shared operations. It's like that. That's basically more of the same, by the way, with different divisions within Vodafone just passing around revenue and charges between business units. That's all that means. It's meaningless and actually probably counterproductive against simplicity. Um, yeah. Local markets, restructuring, execution. Again, first of all, I'm skeptical about the restructuring. And secondly, like, let's see how we manage local markets. HQ simplification. Okay, so some head office jobs are going. So what? And again, here, right, it kind of doesn't really chime with the previous slide, right? So, okay, we're bringing all this stuff into a final structure, but we're also then expecting countries to be doing all of this stuff as well. So what, we're now going to end up with like 10 different HR teams in different countries, 10 different legal teams, 10 different branding teams. Like, is that really the direction that you want to go? Does that somehow reduce complexity? What, and then you're meant to charge each other or commercialize shared operations? So what, HQ is going to be billing local units for services? Like, where's the simplicity here? It's like step down in-house, so I mean, error, product development, and it's like, again, to me, this is a bit of a problem. Like, okay, you kind of need the development, right? Like, we talk about the improvements in customer journeys. Where's that coming from? Is that going to be a third party? How is that going to be managed? Because it sounds like it's not going to be in-house, right? You just imagine that customer journeys just magically fix themselves. Like, no, they don't. You're going to have to like spend money developing the system. So if you're not doing it, then you need to engage a third party to do it. And again, how's that being managed? There'll be a big project team in in Vodafone that may or may not be able to manage that correctly. All right, and individual accountabilities, fine. Yes, that's probably useful linked to incentives. So all right, yeah, that is a good way to manage, especially like sales organizations and people who are quite hungry for money. Similarly, as well, customer services teams can often be managed that way. But you also have to be careful that you're not introducing things like poor controls or fraud or abuse, right? Because the easiest way to improve your customer services measure is just to give people credits and payments and refunds, right? That they'll love that, right? Free products, just give it away. That's the easiest way to bring up your customer services measures. So it's like, you need to be smart here with how you incentivize people, and you need to make sure that you're doing that correctly. Because again, I've seen some crazy behaviors when you incentivize incorrectly. I won't name drop companies, but I've definitely seen it a couple of times. And then it's like growth, so continue pricing actions. Now, I'm not quite sure how to interpret that. One of two ways. It basically either means passing through price increases and probably justifying it through inflation, or it means discounting to basically incentivize products and sales and etc. And likewise as well with Germany to make sure that you're selling as many services as you can, even if you're no longer allowed to bundle them into a single contract. Okay, Germany turnaround execution. Again, Germany is so important for Vodafone, it does need to be turned around, but it's a really tough market. I actually believe that Germany is the toughest market in Europe. The UK is close, Netherlands maybe, maybe Spain as well is pretty tough at the moment. Turkey has its own challenges, but I think overall Germany is really tough, really competitive, and difficult to make money in. Yeah, commercial traction in Europe, again, I think that's clear. Drive B2B digital services penetration. I'm not quite sure what they really mean by that. Again, digitization is such a buzzword in the industry, and yeah, okay, like again, what level of B2B? And support Africa financial services growth. So I completely agree with that, by the way. No arguments from me. And as we'll get to Africa very shortly, they're really good at it. It's very high growth and lots of opportunities. And for anyone who's not aware, like Africa doesn't really have a landline infrastructure because of the size of it and everything that Africa's been through. But it has an incredibly sophisticated and fairly modern mobile network, and within mobile network it has kind of a lot of financial services that are embedded into telecoms infrastructure, which the likes of Airtel, which the likes of Vodafone can take advantage of. And again, there's no challenge from sort of your IP networks or anything like that. It's just not feasible to be building fiber networks across, Sudan or huge expanses of desert, and etc. So there's definitely opportunities in Africa, and I think it does make sense for Vodafone to continue to focus there. It's all the exciting stuff basically, and potentially allows them to turn themselves more into like a payment processing kind of company, which again is definitely a growth area that telecoms can grow into. And to be fair, Vodafone call out IoT themselves. That's kind of the direction of travel for IoT, where you kind of embed SIMs into devices, not just phones, but things like ATMs, CCTV machines, that kind of stuff, and then you get a rental from them. Basically, that's definitely a viable way to make money from telcos. So that to me, I have no problem with at all. That makes sense. So here we got our investment, our 250 million that we save in firing people basically goes back into customer development. We'll see how that looks like. Again, new SIM customer journeys. Fine, we'll see what that looks like. SME journeys. So by the way, small, medium enterprises. But again, really, if you delve into this, it's SOHO rather than SME. So SME would be like 5 to 50 people. SOHO is like 1 to 5. It's like the really, the very low users perspective. They call out SME here. By the way, different people have different measures for things like SME. I've seen SME go up to 250, which I would definitely suggest is no longer a small business. But I think 50 is probably a reasonable cutoff. So 11k roles are going over 3 years. Okay, some action groups in Germany and Italy. Spain also needs an action group, by the way. And to be honest, the UK probably does as well. Like, the UK is sort of ambling along because it's hoped that there will be a an integration with 3, which would then basically make Vodafone the largest mobile provider in the UK. It also would likely give them 10 to 15 billion of debt, and may well just basically be, funded from sort of Italy and or Spain, from that perspective. So again, I think it's okay. You would definitely see a big challenge to EE specifically, but I don't really think it would be transformative. It doesn't really fix the problem, which is endemic to Vodafone. And by the way, 3 is better than Vodafone for sure, but not by a ton. Again, the big standout for me is actually Telefonica O2. When I dealt with them, I was really impressed. And not far behind is EE. EE is also pretty good, especially compared to BT. It's still way more commercially minded and smarter than BT PLC. So, so I don't really see an integration with 3 fixing their UK problems. And so again, I think it's not correct to not include it, and indeed Spain, in this as well. I guess in fairness, they put Spain under growth instead of simplicity, so maybe they think Spain has different problems. CapEx reallocated from lower to higher return on investment markets. So again, it's difficult for me to reconcile that point, right? Because you've got the likes of Spain, Germany is kind of break even, sure. The UK and Italy, and they're like negative. So it's like, okay, so you're going to be moving stuff to higher markets, which basically means, Africa and Turkey and that kind of stuff. But then how are you going to fund this turnaround in those countries where there is a negative return on investment? It doesn't really gel. It's kind of, it's very inconsistent, right? It's not just me that sees this, I hope. And then, so they did use this 6.5 billion to pay down debt. But again, I would say Vantage Towers was a big one for them, right? It kind of made sense. And okay, it also does make some sense to sell it, but it's a bit of a shame because it was one of their better assets. I guess if you were looking for a bullish thesis on Vodafone, you could say that there is definitely an opportunity to spin out a lot of assets within Vodafone, right? Again, you've got like 11 billion here, 5 billion there. It would be very easy to kind of improve the market value of really not necessarily Vodafone, but the component parts of it. And I think it's kind of a failure, a long-term failure within Vodafone, to not realize the assets that they bought particularly well. And again, I think they've acquired incorrectly. I think their cable and wireless acquisition was especially bad. But again, they've also made some poor acquisitions and growth in Germany as well, and are saddled with a legacy network. So it's like, it's not so easy. But again, I think you could make the argument there is some value to be extracted in a lot of their business units that they're not currently doing a good job in extracting that value from. So again, evaluating our process, this is basically the measures component, right? How are we doing? Net promoter scores, this is NPS. Fine, it makes sense. Hopefully they're already measuring it. And then it's like deep detractor reduction. I'm not really sure what that even means, by the way. A detractor is a word from NPS scores, but it just basically means a negative NPS score. So I'm not really sure what a deep detractor is. Don't know. Network reliability, yes, again, people just expect networks to work all the time. And then revenue market share. So, basically they're going to be looking to grow by acquiring more of the revenue within their market. All right, fine. Makes sense. Simplicity, Europe net OPEX savings. Again, it is definitely possible for you as a business to drive OPEX savings. It's typically, though, going to need to be a very efficient business with, minimizing customer contacts, improving that whole journey so that when they happen, they're slick and understandable and good. Potentially some AI, right? That's definitely BT's approach. But they are also going to have to invest here in order to realize those OPEX savings, right? They won't just magically happen by whipping people in the customer services team, right? That's not how it works. So, they need to be smart about this. And I think, again, set a return on investment. Now, okay, that maybe that 250 million is going to be enough. Again, I'm somewhat skeptical about that figure, to be honest. I've seen big projects in big telcos before just burn through money at a rate you can't imagine. So I'm very, again, skeptical, but maybe. Industry productivity benchmarking. Again, what are they measuring here? I don't really know what the purpose of this is. Presumably there's some sort of efficiency drive, but in order to measure that, you'll basically need a bunch of reporting people and analysts going around measuring it. So it won't just magically produce it, because at least I'm really hoping that there isn't existing data that tells Vodafone how inefficient their business is. Because if there is, it's shocking to me it hasn't been actioned already. So I'm assuming it's not being benchmarked just yet, because otherwise somebody would have done something about it, I hope. But again, it's like, okay, so somebody's going to tell you that there's a problem with your productivity. Then you have to invest in order to improve it, right? Okay. Shared operations, NPS. Again, what does that mean? I don't know. Team engagement, sure, yeah. Again, a big company will always be doing team engagement. So where's the simplicity here? I don't know. Growth, okay. Revenue, adjusted a bit does after lease, fine. Free cash flow and return on capital. All right, fine, yeah. Well, these are all measures, but again, we have to work out how we're going to measure them and then what we actually do from the measurement, right? That's really the important thing. It's like, I used to work with somebody, and as soon as I sort of gave them a report, the first thing would be like, well, so what? So what? It's like, well, the ARPU's decreasing. Okay, so what? What do we need to do about that? Is there a reason for that? Should I be concerned? Is it good news because we've got new customer acquisitions? Is it bad because the new customers are at reduced ARPU? Right? It's like, okay, well, what does that mean? So it's like, well, what? Because data is only data, but actually what it should be doing is driving insights, and that insights should be driving actionable change. So we'll see. A new roadmap for Vodafone. And again, we're back to being best-in-class telco in Europe and Africa. But it's like consumer back to basics to win in the market. Maximize potential of Vodafone Business. Okay, maybe. Leaner organization. So to be honest, I kind of think this makes sense. This is basically all about simplicity from my perspective. And to be honest, what they probably need is simplicity, something about technical, and something about commercial, right? You've got the simplicity about making things easier, more organized, and simpler. That makes sense. In order to maximize potential of Vodafone Business, you need a network that works, you need a back-end system that's accommodating, and you need the commercials to basically go out and win business beyond a guy in his shed, right? So it's like, how do you maximize that potential? You need to kind of think about it more than that, I think. And in a leaner organization focused on value. Again, I get it. That does make sense. And again, if they can organize the £250 million to correctly drive OPEX improvements, there is absolutely an opportunity there to... I mean, I call it cost to serve. That should be a measure, and it should be familiar to people within Vodafone. It's basically like, how much does a customer cost to serve? How much are you spending, right? Let's say that you're spending the customer is spending £25 a month with you. Okay, so that's £300 a year. Of that £300, how much actually turns into real cash in the bank, right? Because you'll have product discounts, then you'll have credits for things like network performance, and then you'll have your own overhead absorption costing. And then you have everything else, right? And it's like, you need to make sure that you keep as much of that £300 as possible. So that is definitely possible to do. But again, I'm dubious and need to be convinced that Vodafone can actually realise that. So in terms of financial performance here, so revenue growth only grew because of Africa, to be clear. EBITDA was down and is expected to be flat next year. There's some return on investment here, but again, it's like, it's not very good and it's flat for a number of years now. So what more can I say? And dividend has been maintained. There definitely is some concern about dividend, and I would also be concerned about dividend, honestly. To me, if I'm Vodafone, I'm looking for some money. The dividend looks like a candidate which could be there. And I think, honestly, Vodafone should should reduce the dividend. It's not in a healthy position. It needs the money to invest. This is part of the problem with telco. Again, it constantly needs to invest in new spectrum, in competitive, in winning customers, in keeping customers. That's expensive. And I don't think they should be paying out the kind of money that they are. Maybe they pay out a little bit, right? But it's just, I think it should be looked at, honestly. So Germany here, really bad. Yeah, cumulative customer losses impacting performance. I mean, that's basically churn. Um, all right, so roaming recovery is kind of interesting. That does make sense. When the certain bug happened in March 2020, usage fell off a cliff. It really crippled usage revenue from a lot of telco businesses. And roaming especially is one of the few areas for usage which still enjoys comfortable margins on the whole, especially non-European roaming. Um, so it's like, okay, so by broadband ARPU, that's probably price increases, and then roaming. Okay, so effectively what they have here is a smaller base with a higher ARPU. That's what's happening, and that's totally normal as well. There are two ways to achieve a kind of figure, right, that you want to achieve: either more customers or more ARPU of those customers. Ideally, you want both, of course, but that's the partial offset here. And in Q3, Q4 pricing actions, again, it's not super called out what they actually are. Trade-off with near-term net additions. Okay. And then EBITDA declined due to service revenue shortfall. Yeah, okay. And by the way, increased energy costs. I mean, it's interesting here. I mean, that definitely would be significant depending on exactly where the costs are being allocated. But really, the main problem here is that they're losing customers, and although there is some ARPU improvements, actually there's some really worrying regulation coming from Germany. And I would actually say that the regulation and the regulator in Germany is the toughest that I've personally dealt with in Europe. Like, there are a bunch of very specific German regulations around like payment rules and how you can cut customers off, how you can contract them. The way that you engage with customers kind of minimizes opportunities for upsell and cross-sell. And it's like, it's really restrictive in terms of what you can do. The data you can keep is also limited. Like, the whole kind of Cold War and the way that like data was used to monitor people in Germany has kind of left an indelible mark, where German regulators like are really strict on how you can use data, on how you can communicate that with customers to do things like, yeah, offering additional products. So it's really challenging. And this bottom point here with TV, like, it's very common for telcos to want to bundle services, right? It was duo play, triple play, and quad play. And what that basically meant is that you would get a customer onto TV, onto broadband, onto mobile, and onto landline. And if you got all of those things, then customers were so sticky that they would never churn. But the problem is that Germany has now introduced a new regulation where they want to be splitting out the additional products on top of the broadband. And this is basically a problem, because now Vodafone in Germany have 8.5 million customers spending 800 million euros a year, that they have to like recontract or risk losing that revenue to elsewhere. Like, the best case scenario here is that their revenue is unchanged, right? And I mean, there'll basically be everyone in Germany like licking their lips at this great opportunity that's about to come from incumbent telcos who, you know, maybe don't have the best customer services, or maybe don't have the best commercials, or etc. So I mean, that I expect that they'll lose a chunk of this revenue. How big that will be and how much they'll be able to sort of put these price actions in place, we will see. But yeah, that's a nasty change for sure. Yeah, that's the main one to call out here. I am curious what their legacy tariff simplification looks like. Again, super common to have this in legacy telcos, where, you know, basically commercial teams across years have done new products, new propositions, etc., and no one ever tidies them up. And then eventually, when you do things like price changes or system migrations, it just becomes an absolute nightmare. Because there's no consistency in it. So yeah, I've seen that before as well. So simplification here is actually a good way to improve the OPEX. It's quite subtle, but it is very much it can be a significant cost impactor for there. So I would point out Vodafone Business here, which is one of the better parts for sure. I thought it was interesting that they excluded Spain, and I would say within this deck it's muddied in the way that they sometimes separate out business, sometimes don't. Yeah, I mean, they're saying here strong growth in corporate, SME, and public sector. It's difficult for me to say, and certainly not clear from this deck. Also, as well, I do know a few less senior people in Vodafone, and that's really not the impression I get at all. It's not the impression I get at all. There is some public sector growth, to be fair. Again, the branding kind of helps here pick up the phone with, a procurement person from a government business, but it's not so easy, basically. Margin expansion and good incremental return on investment, that is plausible for sure. Like ARPU to business customers is much higher, and if you have a big network, you can leverage that network because businesses and consumers use the network at different times of the day, so you end up with a very supplementary network for both bases. So there's definitely that efficiency. If you can build a big enough network, you basically end up being able to sell to both segments very easily. Just from a network perspective, you still need to make sure that your commercials and everything else are in place to take advantage of that. So curated and segmented specific product portfolio, it makes tons of sense. There's huge differences in what SOHO, SME, wholesalers, corporations need, right? Different sized businesses need different things. Absolutely true. This IoT here is a fair call out. I think it should mostly relate to the Africa side of things. But yes, it does make sense. Like Sims are now in so many things that, again, you don't make a ton of money for each individual Sim, but you don't need to. They're hardly ever used. One of the easiest recurring revenue streams I ever saw was from ATM machines in casinos, right? That's a network connection. That's how that works. And you don't get any revenue for like calls or anything like that in most instances, a few exceptions. But on the whole, it's basically just a Sim. A connection that you put in, and you make money from that, right? So again, actually for ATMs, you tend to have a landline, but it could be a SIM for things like devices that are ordering, for example, for your fridge or things like that. So there are definitely good opportunities here. It's very low margin, but it's such an easy sale once you can get it in that it definitely pays for itself. So there is some opportunities in IoT. I can see that. And then this VHub reaching 5 million unique visitors. This is more of a marketing thing, but sure, it's good. It basically shows that customers are engaging and using the service, so fine. Then they talk about addressable market, accessing European business demand for digitalization. Again, I've been in so many businesses and departments where people are like, oh, just automate it. And then you actually look at the challenges for automation and you realize it's so difficult because everything has been caveated to death. And sure, yeah, there's going to be digital market growth of 11%. I don't, to me, that's not too relevant. Fine. In terms of the rest of Europe, they say mixed, but again, I think it's important here to look underneath each country. So again, Vodafone here up here is the Germany side is listed as 36%, but you can it's more like 45% once you include the business as well. And again, you can add a couple of percent for each one of these. So Italy, super bad. Legal settlement as well, dragging everything down. Okay, some good business growth, but again, by the way, this is what I mean by the fact that business is sometimes included, sometimes not. But again, it's a very competitive market, very similar in Spain as well. I reviewed Gamma previously, and their Spanish performance was also really bad, but at least they had a good performance in Germany. So definitely another competitive market for sure. The UK kind of going okay, and again here you got double-digit consumer growth. The Vodafone and consumer growth in the UK is kind of working, but what I would say is it's like revenue focused rather than earnings focused, and you can see it here in the numbers. So they're basically picking up customers, but not necessarily the best customers, or they're having to work too hard basically for their customers. So it's like it's kind of vanity rather than sanity, right? It's just like revenue, and this is a business which is not a growth business anymore, really. especially in these mature markets. So it actually shouldn't really be focusing on revenue. It should be focusing on its earnings and looking at what's going wrong between, again, that contracted revenue compared to their earnings. Cash in the bank actually matters. Other Europe was kind of okay, but again, they got rid of some of their lower sale stuff, so it makes sense. Hungary mainly, but fine. And yeah, Spain here difficult. And I mean, again, here CPI linked price increase from Jan 23. That you'll see a bunch of these in telco earnings updates. And again, what should happen is their revenue should increase very materially, like 10% plus from that. The question will then be how much of that they're able to keep, because again, what will happen is customers will churn. Customers will expect discounts and customers will expect credits, and they'll basically reduce your success of that price increase if you want to look at it from a purely financial perspective. So I actually did some work in a previous job at TalkTalk where we were doing twice yearly price increases and by the time you actually were done, there was no real increase in earnings. You definitely saw the increase in revenue. Commercial finance would rub their hands and say yes, success has been reached, and then they would walk away. And over the next couple of months, that revenue increase just got dragged back, so that it basically meant that earnings were flat. And you'd basically just miffed your base. So you'd lose base. So although you would end up with a higher ARPU, you've got a smaller base. So your overall, again, your eventual earnings were just less. So we'll see whether Vodafone are able to keep these CPI increases or not. Some good numbers here, to be fair, as you'd expect. These are all really good growth numbers. I think it's interesting with South Africa that they have such a strong prepay. So prepay just means, you're basically topping up with credit. Post-pay means, you get a bill at the end of the month. So generally speaking, in Europe, the direction of travel is to post-pay. But prepay is still quite prevalent in certain markets. Again, especially African markets, but also, I mean, it's definitely not uncommon in Europe as well, especially in things like the immigration market. It's super common to have, people coming in from Turkey, from Poland, from India, and have a prepay situation. Prepay tends to be higher ARPU, but lower contract values. So you basically end up with this situation. It's not good or bad. It's just different in how it works. And with prepay, it's much easier to win a customer, so you don't care as much about losing the customer. Like, there's an inevitable element of churn. As for example, students, they'll come for a year and then they'll move back, or workers, or etc. With post-pay, it's a lot harder to win the customer, but then you get like 2 years of guaranteed revenue from them. So then it's more costly to lose them. So you just, like, if you go to post-pay, you end up with a very different sales channel and actually a very different customer support channel as well. It needs to be a lot stronger. Whereas prepay, it's more about the network and actually what it can do. So yeah, that may well change over time. It may not. It may be a kind of peculiarity, I guess, of the African and to a lesser degree Indian market. But we will see in time. So moving away from individual markets, basically everything is either flat or going down. Most of it's flat. Again here, the fourth bullet point about spectrum payments, super common. You're just constantly having to invest in 5G. It'll be 6G soon, and that will not stop anytime soon. So that's a challenge that Vodafone has. It does get slightly better on the next page when we look at deleveraging. So this is really good. And again, you can see here that they've used their sales to pay down a significant part of their debt. I think this is good for them. I think they should pay it down a bit more. But the fact that, as you'll see in a second, we're now at kind of less than 3, at 2.5. EBITDA to debt is the right kind of direction. I think I'd like to see it a bit lower, something like 20 to 25. Honestly, I think they need to sell one of their divisions, maybe Spain or Italy. They did actually get an 11 billion euro offer for their Italian division about a year ago. So it may well be worth it revisiting that. But yeah, that's the kind of size that you're looking for. Non-Germany for each country, you'd be looking at kind of 10 to 15 billion, I suspect, kind of number. So yeah, I think they need to sell at least one unit, but I think I would favour selling both just to really give them some firepower and some room to breathe. So in terms of guidance, and again, this is really gloomy, it's basically a year of broadly flat. But again, broadly flat in terms of EBITDA, but actually cash flow is expected to be under severe pressure. So yeah, it's basically where they've sold off stuff, right? There's just less stuff now. And to me, especially, again, Vantage, that was making a contribution that's no longer going to be there. So it's like, okay, well, the debt has gone down, but so is cash flow. And actually, the free cash flow here is quite a significant reduction. So we will see. Like I say, for now, the dividend appears safe, but I'm not super confident that it will stay there. So again, a new roadmap. This is I mean, it's not the same slide. It's slide 24. We were looking at whatever it was earlier, but it's basically a copy of that slide. So yeah, I guess to summarize here, Vodafone's share price when they published these results got beaten up, and honestly, completely understandable and relatable. It's really bad. And I'd also point out that, the new CEO had already spent some time basically setting expectations that this was going to be rough, and Vodafone share is already so cheap. Like, if any of those situations hadn't happened, if this was a more expensive share price or expectations weren't set, like the share price reduction should have actually been bigger. I think it was almost, setting expectations that it was going to be really bad, because this is pretty poor. And it's difficult for me as a kind of, in the industry and potentially as somewhat of an analyst to really see an easy way back for Vodafone. Like, again, I don't want to say it's impossible. Like, HSBC are another legacy business that's done a good job improving their situation. Aviva, likewise. Like, it's not impossible to do it. It's just, I haven't seen any sign yet that it's going to happen. I think this is, again, I know this is meant to be like to investors and to analysts, and maybe it makes them feel good, but it doesn't really make me feel good. Like, there's too much ironically simplification in here. There's not really enough depth, and I'm not convinced that Vodafone have a full understanding yet of the kind of the pulls and pushes that's going to happen, as they strive to improve things in markets that have a good return on capital, and what's going to happen to these markets that are struggling, right? And these are the big legacy markets that still underpin a big majority, actually, of Vodafone's overall revenue, right? Like, is Vodafone actually planning on ditching markets? Is it planning on ditching segments? Is it going to, specialize in doing the SOHO providers, maybe SME? And again, from a technical and commercial perspective, and I don't mean technical like network, Vodafone has that. I mean, again, getting value off the network. That also needs technical expertise in terms of how you build what's called BSS, so business support systems, to underpin that. And that's where I think Vodafone are especially weak, and it's a problem because, again, connecting usage is no longer enough. You have to be able to show customers and ultimately show investors and Bossog that you're serious and that you have a plan to realize this. Anyway, that's an hour's worth of talking about Vodafone. That was at least double the length that I was expecting, but I'm deeply bearish on this company. I wanted to spend some proper time on it and really explain. I could be convinced of a turnaround. I definitely have been known to change my mind. And in fact, the last company I was this bearish on, Unilever, has kind of moved in a positive direction over the last year. Likewise, paying down debt. Likewise, simplifying their business, right, just into 5 market segments in their case, and I think moving in a positive direction. Still some concerns there, whereas Vodafone needs to start showing me that same level of detail that I'm getting from Unilever, right? That kind of detail about, if we increase ARPU, what does that mean in terms of our customers? That's what you actually see in quite good detail in Unilever's earnings report, by the way, if anyone wants to have a look at it. Like, that's kind of where I want to see Vodafone, right? If we do the CPI increase in Germany, this is what's going to happen, and this is okay. This is how we're going to manage it, right? And these are the segments that are going to be responsible and how it's going to work. This is too high level for me to really see that at the moment, and therefore, because I have no confidence in Vodafone, this level of vagueness doesn't give me additional confidence. It's like, yes, they've maybe identified the problems to a point, although not enough, and not in enough detail. So that's my current position. I would not touch Vodafone. If I shorted shares, Vodafone would definitely be up there for consideration. It does look cheap. If they can succeed, or they can sell off parts of the business, there's definitely money to be made here. It's definitely value, though, rather than quality, and the Vodafone are in trouble. I don't really know how else to sell it. That is my opinion. It is, of course, always just my opinion, so I welcome different opinions, or indeed the same opinion. Otherwise, thank you very much for watching, everyone, on this extraordinarily long video, but hopefully it was interesting. I've been the Boss Hog, and good luck with your investing. Bye for now.